Hi, my name's Tony Suick. I'm a financial advisor. I'm one of the partners here at Lifetime Retirement Partners. And one of my primary roles in the group is to manage a series of investment portfolios for some of our clients. In that, one of my responsibilities is to, on a quarterly basis, draft a monthly, draft an economic outlook and a market outlook for the quarter. Um, and so we've done that on our website for several years, lifetimeretirementpartners.com. You can always find the most current version on our blog. But in 2026, I started recording a YouTube version of that as well. I will tell you, it's not necessarily for the faint of heart. Last quarter, I think it was like 53 minutes or something in that neighborhood. What I can tell you is at the end of it, you'll come away with a much better understanding of where the market is, where the economy is, where we think things are heading, and hopefully we'll have some fun with it, and it can be kind of educational as well. And so I am going to jump right in. I know it's a long process. I look at it as kind of it's almost like some of the stuff I go through in an investment review with my clients, and I think there's a benefit in providing that to a larger audience. So I'm going to start talking through what we've kind of seen so far for the quarter. And the first thing you're going to see here is the actual presentation piece. This is the version, the PDF version I've published for years that shows up on lifetimeretirementpartners.com. And what I really wanted to toggle to here as a starting point is just the actual index performance numbers for the quarter, and give you a little bit of longer commentary for the year on that as well. We see every stock market up pretty dramatically in the second quarter of 2026. The S&P 500 up nearly 15%, the NASDAQ up over 20%, Russell 2000, which has been the big hero so far this year, small companies really overperforming the market, up about 22% for the quarter. Where you really didn't want to be is commodities bought at the peak. 13% down for gold, 33% down for oil. As we all know, there's a larger story to that oil decline where it's almost interesting how the cantilever of one quarter to the next quarter tells two completely different stories, and that's because the memorandum of understanding with Iran was signed in April, but really the valley of the stock market was around April 3rd. That might not be the exact day, but it's around there where we started to completely turn in the other direction. It might have been April 7th, but in that neighborhood. And so the first quarter, pretty dire performance in all of these things. Every one of the indexes was down. Gold might have been down for the quarter. I don't remember for sure because it had a huge run up, but then it started selling off with Iran. Bonds were down, and then oil, of course, was way, way, way up. But then to go down 33%. And so it gives us an idea of what we saw in the second quarter. But it's not the entire story for the year. Off the top of my head, I think the S&P 500 is up something like 8% for the year now, because we started at a negative number in the first quarter of 2025. Now, in this video, I'm more than anything, I'm just going to talk about kind of the current economic condition and then build an outlook for that at the end. And some of that is just kind of opinion. A lot of it is obviously rooted around a whole bunch of facts that I'm going to go through. And I'm going to start with what we call our early warning system. And so a quick introduction. One of the things we rely on to kind of know where we're at in the economy and the stock market are a series of, I don't want to say calculators, built around a database, built around a bunch of different data points, and then kind of filtering for different things. One of those, the early warning system, uh, detects the economy. The other one's built around the stock market, and I'll get to that in a second. They're similar animals, but they are built for two completely different reasons. And so the early warning system is built around economic fragility, is the key phrase, where we wanted to build something, and the idea isn't strictly to like predict recessions, but it's to say, okay, when are there warning signs in the economy itself, having little to do with the stock market, except for some stress tests that are built into it. And so it's really built around things that economists believe are forward predictors of recessions. And again, the idea, I'm not trying to tell you I'm going to predict the next recession, but we're looking for is fragility in the economy to kind of say, okay, does it feel like a good time to even be investing or not? And so I want to walk you through that. Again, I'm not going to look at every single slide because this presentation is several slides long too, just to give you a little bit of an understanding. We break it into three core buckets: financial strength, macroeconomics, and market stability. You can see the score right there, so I won't waste your time building suspense. The current score is 2.3, which categorizes as benign. The average score you can see down there since 2007 has been about a 3, and so we're actually in a more tranquil than normal economy right now. And that's been the case for most of the last year, and if anything, the warnings have declined, where this is the last 52 weeks as of the end of June. And you can see back around Liberation Day, there was a little fragility. We've seen a couple blips. You see that very small final blip when Iran launched. And that has to do more with market stress at the time than economic stress, where we broke for 1 week into that early caution area before it ticked right back down. And actually, we've been scoring a 2.3 for most of the last quarter, just week after week after week, which, what do you take that for? I guess as an indication that there isn't a whole lot of fragility in the stock market right now. If you want to see a longer term view, just to kind of get an understanding of what this can look like sometimes, you can see it launch up leading up to the Great Recession. Again, it's built around predictive indicators. You can see it spike massively during COVID, and then you can see it break into that elevated fragility a handful of other times. But what we really see is since the regional banking crisis in 2023, we've been kind of on a general march down towards a pretty tranquil economy, and that seems to be the case today. And so we look at things, and I'm just spitting off some of the indicators off the top of my head, but when we look at things like bank lending, which tend to be a precursor to recessions. When we look at things like yield spreads, when we look at things like relative flows of riskier versus less risky assets, when you start to combine a bunch of those data points into a grade, so on a 0 to 10, we're scoring the economy right now just in terms of fragility at a 2.3. And obviously, the lower the score, the better. You can see this is built to be fairly sensitive and fairly reactive. So if you look at the history, actually, it doesn't spend almost any time sitting at 0. And there's also only 2 times in the last 20 years where it's broken above even 8. And so you see a lot of movement, but we don't see a lot of movement lately. Does that mean the stock market's going to go up? No, of course not. That's not necessarily the point of the calculator. What it does tell us is that we don't see a lot of fragility that tends to presage or set the table for significant economic events. By the way, I should mention that current copies of these are pasted on our website on a pretty regular basis, and you can always find those on our blog as well. Next item, again, very similar, but used for a completely different purpose: momentum and volatility index. And this was designed, it's really around 4 different data points. And instead of looking at the economy, the intention is to say, to filter out volatility, I guess is the way I kind of like to explain it. So it's built around the movements of the S&P 500. It's built to test volatility, and it's built to test momentum in the stock market. It also has some components that grade economic weakness as well, because the idea is to basically decide if volatility, when it's present, or also momentum, but volatility in particular, when it's present, I don't want to say good or bad volatility, but is it static, or is it an indicator that something else is breaking down when we see volatility spike up in the economy? And so I don't want to make it too long because there's a lot of other stuff that I want to go through, but you get the idea here. And right now, that's a score of +2. The inset graph there looks back over the last 52 weeks, and we really only see 2 declines during that. So remember I said that the early warning system is calibrated to have a lot of movement inside of it, is the idea anyway, even though we haven't seen a ton lately. This is built with almost the exact opposite purpose. I don't want this to be constantly moving around. I want it to only react when there's a concern out there. We saw this negative around Liberation Day. We see it during that October volatility surge where we had kind of a weak stock market starting in late October and then going through the first part of 2025. And obviously, we see this drop off in the most significant area starting actually before the Iran conflict launched with some of the fears around AI and people getting pretty nervous about the stock market and the implications of AI on jobs. You remember all that stuff Anthropic was announcing in the first quarter, where they would come out with an announcement that their new AI software was going to replace cybersecurity. And all that volatility was the triggering event that started dragging that score negative. Of course, it ends up being correct, at least in hindsight, because we did have market weakness during the two areas where the momentum and volatility index indicated you want to be a little more conservative. On on April 3rd, that score switched from being negative to being zero. And then the next week, on the 7th, it popped up to a positive 4. And so, exactly when the stock market started ripping for a period of about 60 to 70 days, this scored a positive 4 and then positive 3 every score after that. Now, in the most recent week ending the quarter, has ticked down to a positive 2. Still risk on, maybe a little more warranting of caution. To give you a quick, not that it's even that germane, but to give you a quick idea how I use this managing portfolios. For example, one of our portfolios is always between 90 and 100% in stocks, one of the more aggressive ones. This is the kind of tool I use to say, okay, well, do we want to be 100 or do we want to be 90? And this is how we kind of, without thinking we can necessarily out trade the market, figure out, okay, when should we step aside a little bit? It's we want to be aggressive most of the time, is what I tell my clients. We want to be aggressive 95% of the time, but it's okay to dial things down a little bit sometimes too. And so positive scores for meaning a small score for the early warning system, positive score risk on for momentum and volatility as well. So in short, we think it's a good time to invest, remains so, but there's a lot of other details to kind of filter into that as well that I want to go through. And so now I want to start moving through my main slide deck. And this is the part that gets revised every 90 days, although it's built around our database. And I post a lot of other updates during the quarter. This particular presentation, like I said, I updated every 90 days for this purpose. You can find this on our blog as well. So all the attachments that I go through will be part of the Q2 economic outlook that we're going to post as soon as this is published. So any more details, you know where to find them. um, I like to break down the economy and the stock market into quadrants to kind of assess where we are. And so each of these pieces we will go through in more detail. And candidly, each of these, I actually have 4 presentations that we update pretty often. One for each of these quadrants that goes through a lot more detail than what I'm even going to go through today. Macroeconomic indicators, strength of consumer, monetary indicators, market fundamentals. And you'll notice in 3 out of 4 of those, we assign a grade. The grade is -2 to +2. And right now, we're looking pretty positive. You can see in market fundamentals, I don't like to assign it a specific grade. We just like to say, does the stock market look attractive? Does it look unappealing? And give a kind of a general score combined with where we think the economy is. I'll highlight first the things that have changed over the last month, but really the last, in most cases, since the beginning of the year. We've seen macroeconomic indicators actually drop a little bit, +2 down to +1. This had been, I believe, at +2 for the entire year so far before dropping. Actually, when I updated the score at the very end of the quarter, the drag on that is new housing starts, which actually had been showing some strength in the first couple months of the year, but then dropped down in April and May. Um, to be a negative indicator for that. And so the overall score changed. That was the contributing factor in there. Strength of consumer, we've actually seen strengthen over the course of the year. Some of the strength of consumer stuff is what I'll talk about most during the presentation today. That started as a negative score at the beginning of the year. It went from -1 to 0 to +1 to +2. And that has a lot to do with the kind of firming up. I won't say it's a booming stock market, but the firming up in the labor, where we had seen a lot of weakness towards the end of last year. And a lot of that has rebounded. Monetary indicators also a +2, same scale, -2 to +2. And that's been a +2 for the entire year so far. That's built around both things like private bank lending and also monetary policy from the administration of the Federal Reserve. And so we're still looking at an awful lot of green on this page. Things have moved around, but probably more than we were looking at the beginning of the year. Sorry about that. We had a recording issue, but I think this is where I left off. So I believe we're in a mid-cycle economic expansion, meaning we're in a bull market. And I don't believe we're towards the bottom, and we don't seem to be towards the top right now either. And that's defined by a couple of factors. This is just a quick summary. I'll go through these in more detail, but we see continued expansion in the GDP, or as I'll talk about it a little bit, gross output, a similar indicator that I like to use. We see sufficient bank lending to lubricate an economy, corporations continuing to outperform expectations in terms of their earnings and growth, low market volatility, generally true over the last year or two compared to other cycles, a stable or growing labor market. So we have all of these things right now. That's not to say it's a perfect economy, but it's certainly not defined right now as an economic peak, which is what people are primarily worried about at this stage. I like to break, just the old T chart. What's good, what's bad. I like to break it into market positives, neutrals, and points of concern. And I won't talk through these in very good detail because some of these are going to be on the subsequent slides. But this is available on our website if you wanted to download it and review it. And so I want to go through some of the key points now. And I'm going to start with a couple of slides on market fundamentals. And I guess I'll start by kind of defining it just for everybody that's watching this for the first time, maybe. And so, yeah, and I'm just going to make up numbers. You might have Apple at $100 a share and Google at $200 a share. Those are very arbitrary numbers, and people get confused just by the actual share prices because each company might have a completely different number of shares outstanding. And so what we do is we have to create ratios to compare apples to apples to apples. The most common one is a price to earnings ratio, in which case we take what a stock is worth in terms of its stock price and divide it into what the company earns. And when you do that, then you compare different companies. Here, instead of looking at an individual company, we're looking at indices. And so, for example, with the S&P 500, what we're really doing is taking the price of all 500 companies divided by the earnings of all 500 companies to get at a comparable value. And we're comparing that to where we were a year ago. And so you see for the S&P 500, 24.99 is only slightly higher than we were a year ago, 24.09. And actually the forward 21.47, and I want to talk about that for a second. So it's is the market more expensive than it was a year ago? Yes, slightly. What's that? The equivalent of like 2%? And so you might be saying, well, hasn't the stock market gone up over the last year? Well, yeah, but so have corporate earnings. And almost all of the stock growth over the last year is explained by changes in corporate revenue growth or earnings per share growth, which is essentially net revenue. The forward is actually, I don't have it on this slide, but 21.47, that's actually slightly lower than it was a year ago. And that's, to me, the far more important one. And to just explain the difference, 24.99, the current ratio, says, okay, what did a company make over the last 12 months? and then divide that into the share price. Well, you don't buy a stock based on what it made last year. You buy it based on what you think it's going to make in the future. On a forward basis, meaning take future expectations for company earnings, divide that into the current price, that's a much more informative number. So 24.99 is the one they always talk about a lot more on like CNBC. Kind of drives me nuts because what's important is the forward view, which has actually declined a little bit. It's a couple percent, but it's cheaper than it was a year ago, meaning we've seen pretty good stock valuation increases in the stock market over the last year. They haven't even gone quite as fast as forward earnings have climbed. I will point out one other thing on this graph, one area that's making me a little nervous, the Russell 2000. We're investors in small cap and mid cap stocks, although I think we'll probably be looking to pare that back some. A year ago, the forward was 32. Now that tends to run higher than the S&P 500 because small companies just in general aren't as profitable as mega cap companies. But to see that in 1 year go from 32 to 39 and also see the forward earnings higher than the S&P 500. Like I said earlier in the video, the Russell has been the rock star for the year. That's the index that's up the most so far. I think followed slightly behind it by the NASDAQ. But 32 to 39, that's starting to get pretty expensive. And so I wouldn't be surprised if we at some point start to pare back on small cap and mid cap holdings. Now, one thing I like to talk about with clients is just why does the stock market move up and down? And of course, it can move around for all kinds of crazy reasons, or all kinds of perfectly legitimate reasons that are fairly short term in nature. But so I'm talking about like political events, things like that. What stocks correlate with the best over time is their own earnings. And if that's not just obvious why that is, every quarter most companies in the S&P 500 and any index really announce that publicly traded announce here's how we did for the last quarter and for the next 3 months or 1 month or whatever guidance 1 year or whatever guidance they want to give. Here's how we project we're going to do. And so sometimes stocks are moving around in a way that doesn't have a lot to do with that earnings announcement. They come out with a new announcement on a schedule, and all of a sudden the stock goes up or down to correlate with those earnings. And so we go through what's called earnings season that usually lasts about a 2 month roughly period, with a 1 month valley where there isn't a whole lot of news. But during that period, that's really what's driving stock movements is the announced earnings season. The last couple quarters have been mostly good. There have been a few points of weakness. In fact, the end of 2025, which would be announced at the beginning of 2026, was a little sluggish. And that's one of the reasons you saw the stock market cool off a little bit in the first half of the year. The saving grace for the stock market was that in 2026, quarter one, meaning we start announcing those in April after the quarter's over, we saw huge and unexpected profit in the stock market. That's true in terms of revenue, but it's especially true in earnings per share. So I'll try to dial in. I know the presentation itself gets a little small in this format. The last 5 years average gross revenue outperformance was 70%. And I'll come back and talk about outperformance in a second and why companies tend to outperform, just because I like talking through things, I guess. You see that up to 80%. And so in the second quarter, we saw a very strong number there, even stronger earnings per share. Companies that outperform 84%, average size of outperformance. Look at the historical. Last 5 years, 7.3. Last 10 years, 7.1. Quarter 1, 2026 at the end, 18%. The highest I've ever seen for these numbers. That's why stocks rallied and rallied very sharply in April and May. Because they were down. But stocks don't turn around on a dime just because they've gone down for a while. You need a catalyst to get them to rebound. This is what that catalyst was. Why we've seen stocks go way up, specifically in April and May during earnings season. We see Oh, so I said I would come and talk about the cycle just for a minute, um, because I like to explain it to clients because it's something that when I was younger always bewildered me, even when I started working as a financial advisor. Why do these companies tend to overperform? Um, and a lot of it has to do with just catching up with expectations, and it's kind of where you see companies getting towards the top of the bull market. Um, it- when a company um, gets to when we get to the peak, I guess is I want to say it in the inverse. When we get to the peak of the market cycle, companies tend to have a harder and harder time beating expectations. So those expectations keep getting loftier and loftier and loftier. And as long as they're beating them, like we did in quarter one, then the stock market just keeps rallying. It's when expectations get so lofty that companies can barely keep up that we see the slowdown in the economy. So we obviously didn't see that in quarter one. I'm expecting a very strong quarter two, and frankly, a very strong year in 2026 in terms of corporate performance. One thing that I've been talking about with clients just the last couple weeks. Oh, sorry, but one quick thing first. This is just an illustration of what I was saying earlier, where or maybe I didn't say it. The yellow, sorry, the orange line there is current PE ratio. So it's a graphical representation for the S&P 500 of these numbers for the year 24.99, and then working backwards for 12 months. Actually, I'm sorry, not for 12 months, for about a year and a half I have on this scale, because that's really where they started to diverge. Plotted against forward earnings. So remember I said one was 25, one was about 21. We've seen a delta increase in those numbers where on a current basis, the stocks have gotten more expensive over the last 18 months. You hear a lot of people talking about how stocks are the most expensive they've ever been. Well, that's true on a current basis, but it's not true on a forward basis. And we've actually seen a separation where stock prices over the last 18 months haven't even gone up as much as earnings have. And that's the separation, the delta between those two numbers. You see a huge separation right around Liberation Day. April 2025, and continuing and even widening. Uh, and so are stocks more expensive? It depends on what kind of metric you want to use. On my preferred metric, they've actually gotten cheaper over the last 18 months. One thing I've been talking about with clients a lot is share buybacks. And that's only to point out that the estimates for 2026 are around where we finished in 2025. There was a lot of talk about how companies combined in the S&P 500 were going to buy back $1 trillion. Um, yeah, 1 trillion, sorry, for the first time. And actually, the final numbers finished slightly under that. The projections are for that to not really grow in 2026. So 975 million, followed by a projected 975 million. Now, these projections only get updated once or twice a year. This is from the S&P Dow Jones stock buyback data set, which you can download and play with. But again, they only update once or twice a year. Um, and I just think it's interesting because we had been on a basic uptrend for quite a while of especially mega cap stocks buying back their own stock as a strong use of capital. And in my mind, one of the one of the pieces of evidence that companies think they can do better by investing is when buybacks fail to keep climbing. And what I'm really talking about is companies like Alphabet or Amazon or Microsoft or Nvidia moving away from share buybacks and towards direct investment. Obviously, and some of them could be right, some of them could be wrong, all of them could be right, all of them could be wrong. But obviously, these companies think there's something to the data center build out, the AI build out, that's a lot better use of their capital than just continuing to announce share buybacks. And that's one of the things that as I think through it, is kind of fascinating in the developments of the last couple months. So we're going to move away from monetary indicators. I do want to talk about a lot of economic data points as we finish up the video. So we're probably about halfway through right now, maybe a little further, but I really haven't even gotten into how do I think the economy looks yet. And so that's built around a bunch of different data points. The first one is the federal funds effective rate. I'm not going to sit here and necessarily read the graph to you. My interest is more on just kind of imparting my commentary, where we saw the federal funds rate. This only goes back to 2025. We saw the Fed cut rates several times in 2024, cut rates several times in 2025, and now start the beginning of a long pause. You can see on the inset graph, that gray, the federal funds effective rate is down about 25% from where it was at the very peak, but that's still a very elevated level. And what I've been writing about for quite a while, and talking to clients about, is one thing that when you look at a Fed tracking tool that predicts where the federal funds rate is going to be in the future, are they going to cut? Are they going to raise? Those tools don't tend to keep in mind or in perspective the nature of the Fed itself. What I've always looked for in the Fed in terms of monetary policy decision is for them to give themselves as long of a runway as they can. You have to understand they're mostly working on past tense data, meaning they're getting these reports of, okay, what happened 3 months ago or 1 month ago or 2 months ago, and trying to make decisions around that. I think a lot of times one of the lead things they do is try to give themselves the longest economic runway that they can, meaning they'll cut a couple times and then they're just going to sit there for 6 months. And unless something's broken, and a clear move is required, that they're not going to move things around willy nilly. But I guess my point is that I think we're in another phase where unless um, the labor market really starts to materially deteriorate, or unless the inflation seems to have peaked and start coming back down, we're not going to see probably either Fed cuts or Fed hikes. Maybe for the extent of this year. I'm not in the business of predicting, here's what they're going to do in December. I am in the business of predicting the general trajectory, and I don't think that probably either are extremely likely over the next 6 months. I will tell you that the Fed trackers have switched from at the beginning of the year predicting 2 to 3 rate cuts during 2026, which I always thought was outlandish. You can find my writing on the blog. Um, Now there's 1 to 2 projected hikes, that is, sorry. And I have my doubts there as well. I think the Fed's just going to try to pause for as long as it can until it gets forced into some kind of a move. Um, Monetary indicators, total bank credit is one of the key things I look at. It's one of the things that's built into the early warning system. And what we're looking at, so this is the percent change year over year in bank lending. I always call it the gears of the economy, or the oil for the gears of the economy. One of the first things to collapse when the market starts to slow down, when the economy starts to slow down, is bank lending. Banks can be just like you and me, where sometimes they get worried about getting their money back, and sometimes they get worried about missing opportunities. Things are going so good. And so the typically for a normal economy, banks tend to lend money at a year over year increase in the neighborhood of 3 to 6%. That's the rough range that you're looking for to say things are healthy. We actually, over the last 6 months, peaked above that 6% level. I don't necessarily have a problem with it being higher. We just don't want to see it from this level, which you see is pretty sustained over the last 6 months. We don't want to see that declining, or it's an indicator things are slowing down. Or, if it breaks into that range a little bit, not a big deal. We just don't want to see a collapse in those numbers. But very strong bank lending right now. You can see the strongest it's been in quite some time, and generally climbing over the last 2 years. Um, in terms of strength of consumer, I actually loaded a number of slides for the labor market into this presentation, because there's been a lot of consternation and I think a little confusion in the outlook of the labor market. And a lot of that is consternation and confusion that I share to an extent, because we saw a clear steady slowdown in the labor market, not just in 2025, but basically in general for the several years preceding that, where we had gone past COVID. You saw some atypical, extremely strong employment numbers. So, like a huge unemployment spike and then a huge rebound, and millions of jobs that were out there trying to be filled. We saw a gradual but clear declination. And then in 2025, it really started to look kind of skinny in some of these statistics. Since then, like I said earlier, what's been strange for 2026 is the reversal in that trend, at least in the short term. Doesn't mean it'll continue, but what kind of gives us comfort in where the economy is right now? We had been describing it as a low hire, low fire environment, and that in the main is still the case, but there's more beneath the surface in terms of employment. And so this is the U6 unemployment rate. You hear the U3 when they talk about unemployment on TV, which is usually right now it's 4.2%. I like to look at this one because it includes, quote, employed part-time for economic reasons. So it's not only people that are unemployed, the U3, it's people that are underemployed. And when you see the stock market start to break down, or I should say the economy start to break down, or when you see things start to turn around at the bottom, you see it here before you see it on the U3. Um, this was 7.9% 12 months ago. We had one missing value thanks to the government shutdown. Spike all the way up to 8.7 when we came back. So it was like it was almost like a TV show returning from summer reruns in a completely different place, right? We were at 8.1, we missed 1 month, and then we were at 8.7. And that gave me some concern. That was in November's unemployment read. Since then, we've seen that gradually decline. So you see down 4 months in a row, up a little bit, and down again. 7.9% a year ago, 7.9% today. Has there been some volatility in the job market? Yes, apparently. But I guess one way to interpret this is some of the people that were underemployed have found employment again, is one possible interpretation of the chart. Initial jobless claims, another very key one, because we had seen it climbing. I should have this go all the way back to the beginning of 2025, because we had basically seen it climbing for a lot of a year and now declining starting in late 2025. You see that September read, 230,000, and then gradually moving down, seeing it tick up a little higher the last 2 years, but tick up a little higher in a context of a pretty low overall historical number. This is one of the first things economists look at in terms of breakdowns in the labor market, because you usually see new jobless claims before you even see people show up in the employment, in the actual unemployment data. And so this is the one that's kind of considered to be on a hair trigger. Again, we've seen it tick up a little bit the last 2 months, but that's following a pretty long and sustained decline. So we'll see if those last two readings are any kind of indicator of an issue. My interpretation right now is not really, but I guess we'll see in the coming months. One thing I like to talk about a little bit is the stretched consumer, because that's a pretty popular media narrative, or the K-shaped consumer, and I don't completely discount that at all. Right? When inflation is high, that hits people in the lower income brackets the hardest. I couldn't agree more with that as a general narrative. However, when you look at the data, you see some interesting things. Total household debt outstanding, so percent change. So this is the total debt in the nation, and how much it's changing. So that includes mortgages, credit cards, student loans. When you pile all that together, are people taking on more debt to sustain spending? Obviously, we're a spending driven economy, as any major developed nation is. But what's going on in terms of people taking on new debt to finance that spending? Well, this might look like kind of an alarming chart on the surface. Um, if you look back over the last 2 years, this is quarterly data, so we don't get updates here as often as you would like. Um, we see two big bars, four small bars, and then two big bars again, kind of bookmarking them, right? Well, we had been in this tranquil period where people, for 1 year, remember that's quarterly, so 1, 2, 3, 4 quarters. That very tranquil period where people were taking on debt at the slowest rate in a decade. At the exact same time, the media kept talking about a stretched consumer. Now that's gone up again since then, but it's just gone back to kind of historical levels. That four-quarter lull was the slowest rate of debt increase in a decade. Now, if you want some context, it's normal for this to increase. What we're looking at for is things that are completely out of alignment with inflation, which with wage growth. Um, if somebody's salary goes up 3% and their debt goes up 3%, is that a concern for the economy? Not especially. If the average wage goes up 3% and debt goes up 22%, then there's something wrong. So what we're looking at is this in context with other numbers. But if you look at that inset graph, you see we're really just back to kind of a more historical average in the neighborhood of about 3%. Um, I think I talked about this last quarter too. I just like to explain this graph. You see the negative numbers during the Great Recession, because this starts in 2007. And even those negative numbers, they're a statistical anomaly. It's not that people were taking on less debt. That's not the story of the Great Recession. What actually happened during that window, loan write-offs. People had less debt on paper because mortgages were being forgiven. Basically, companies were writing off a bunch of debt, and that's why we saw that negative. That's I believe, one of the only two times in modern history that's been negative, and the other was during World War II, I think is what it was. And so we would expect to see some growth there. You can see also on the onset a huge spike in accumulated debt going along with the pandemic window, and so that's that big increase there as well. So long story short, this has increased a little bit, but it's nothing that's alarming by historical standards. Combine that. Oh, these are a little out of order. I'll go to the one I was looking for and come back. Real wage growth. And so I think this is really important. I am a little concerned with that big dip at the end, but during the aftermath of the great of COVID, when we had that huge surge in inflation, um, wages were on the decline. And that's not decline in the sense that somebody was making $20 an hour and now they're making $19 an hour. It's all inflation related. Real wage growth is how much are wages growing after inflation, right? And we saw a negative period now for 12 consecutive quarters. This is another quarterly statistic. We've seen positive wage growth, meaning wages are growing faster than inflation. And so combine that with the previous slide where people are taking on debt at a modest to pretty average level, and we see wages growing faster than inflation. We've seen inflation continue to tick up. That's one of the next things I'll talk about. One of my biggest concerns with the economy. But in the first quarter of 2026, wages were still growing faster than inflation. Obviously, the inflation numbers have continued to weaken. And so one of the things that I'm really watching for is if we see a reversal of this for the first time in 3 years, where wages are growing a little slower than inflation, which is definitely possible. Coming back, like I said, sorry, these are a little out of order for whatever reason. Job openings. And job openings are really only useful if you compare them to how many people are hunting for jobs. And so this is built as a ratio. It's job openings per unemployed, essentially. Job openings divided by unemployed over the last 12 months. That had been historically strong again after the kind of after the pandemic, where we saw some atypical job opening numbers. This has gradually been coming down since then. Um, Again, getting very concerning. I keep going back to that basic narrative where at the end of 2025, things looked like they were getting weaker. 0.87 jobs per unemployed person. But since then, we've seen that rebound to the strongest value in over a year, 1.04 jobs per unemployed person. Doesn't mean that that Unemployment isn't a concern doesn't mean that we couldn't use twice as many job openings out there. I mean, the only way to really interpret this is the decline stopped, and that's the important part. That's what I'm kind of getting at. What had been a concern and decline completely reversed itself over the last 6 months. Again, it's not a predictor of the future, just saying we don't see the weakness so far in the economy that a lot of us were looking for. A couple things about macroeconomics, and I am going to start to wrap up here. Just a few more slides. So, gross domestic product. This is an interesting one. I'm going to combine this with another slide and kind of explain it. Gross domestic product has been all over the place over the last couple quarters. So, in the red dotted line there is the forecast published by the Federal Reserve Bank of Atlanta. They have a tracker called GDP Now, which is updated live every time new data is available, and they predict where the GDP is going to be. I put together some stats at one point of I don't have it on the graph here of accuracy. And I found it was well over 90% accurate, but that has really declined over the last couple quarters. So you can see the dotted red line, not even close in 2025 Q1, not even close in 2025 Q4, not really all that close in 2026 Q1. Why do we see all this movement in GDP in what is otherwise, and a weak forecast right now, but who knows if that'll correlate to the actual results? So GDP is affected by two things. One is government spending, and in particular, in some of in the 2025 Q4, the big miss there, where they predicted 2.5% growth, and we got 0.5% growth. That's affected by the government shutdown, and that's affected by government spending. It's also, and this is only relevant to the last year or so, and that's why we lost that correlation of accuracy. This is also greatly affected by tariffs, because that's not when we issue a tariff that changes the amount of spending being done in the economy, and there's mechanics to it that I'm not going to get into. That's just to say that we've seen a less accurate GDP in terms of how well the economy is actually doing, at least in my opinion, over the last 6 to 8 quarters. I like to pair that with what I think is a much more useful tool, gross output. It's actually a similar conceptual tool to GDP, but it measures the total economy, basically, more of the economy. So to read the inset here, gross output measures the total sales or receipts of all industries in the economy, including final goods and services. And so government activity counts for about 10% in this. It counts for almost 20% in GDP. And so this is meant to tell a much better story of actual economic growth. And looking at the same time frame, I believe, go back and count the bars. I don't know if it is or not. You can see a nice steady growth. This is year over year growth above inflation. And we see that 4.8%, 4.8%, 4.7, 4.75 is the most recent read, the strongest read since 2022, 2023, in that neighborhood. And so a nice steady economy depicted in one chart, a highly volatile economy that I'm not sure even exists in another chart. And so I tend to correlate more with this because it sure seems to be a better representation of what's been happening out there in the real world the last couple quarters. We get to one of my biggest points of concern with the economy, which is inflation. And I use, even though it's not the one that's as familiar as PCI, I use personal consumption expenditures. We'll see what Kevin Warsh does, but this was the preferred benchmark for inflation in the economy. It measures goods and services excluding food and energy. Is that the best way to measure inflation? According to the government, which is all I'm really indicating here, the target's 2%. So this is when we say 2% inflation, this is the one they're talking about. Concerning, we've seen that not just like sticky inflation, which is the term I was using for a long time. We've seen this actually accelerating, and it's not just some Iran war, one-time blip because oil spiked. All this data predates the Iran conflict, the surge in oil prices, and we've seen a slow, steady climb of inflation. So this graph starts in mid 2005, and that's basically the where it started reversing. We did see a long, steady decline for quite a while, but we've seen that completely reverse since then, and go from 2.8% to 3.4%. If we continue to see climbs along the way, I wouldn't be surprised if the Fed got to the point of trying to raise interest rates again at some point, but that's not necessarily. I mean, you would have to see it climb for a sustained period of time to get back to at least like inching along like this is what I'm saying. If it goes to 3.5 or 3.6, that's not necessarily a level where the Fed's going to jump in. It's where we see this start to climb in a concerning way. And so gets back to what I was saying earlier. My guess is we're not going to see rate cuts or rate hikes in 2026. I could turn out to be dead wrong, but unless you see employment weaken or unless you see this weaken, meaning get worse, one of those is going to break before the Fed ends up doing anything different. Last couple points about macroeconomic indicators, and I'm going to wrap up here. The manufacturing sector of the economy has been projected to turn around. So we were in a manufacturing recession for most of the last 2 years, meaning 2024 and 2025. There was a projection that that was going to turn around in 2026. What was strange was waking up literally January 1st when that first big spike was posted in terms of the data. So manufacturing below 50 is contractionary. Above 50 is expansionary. There was only 1 out of 48 data points before that reversal that was positive, I believe. And then we turn around and in January, 52, 52, 52, 52, 54, 53. And so a 6-month expansion in manufacturing, which leads to hiring, which leads to goods and services. Manufacturing is the smaller part of the economy. And so one obvious question is, okay, well, if we're in a manufacturing recession, how come we're not in an actual recession? Well, because the services services make up 70% of the economy. Manufacturing is a pretty small percent of it. Services has been in expansion territory for most of the last several years. And you can see the 49.9 there at the very bottom. Beginning of the graph was one of the only negative points that we've had in the last 2 to 3 years. You can see it got up to 56 at one point, but generally above 52, 53 in that neighborhood. So when you combine those two, they speak for the bulk of the economy, and they're both in expansionary territory right now. And so I'm gonna scroll like 20 slides, so give me a second. I should start putting this at the back for these presentations. I'm gonna scroll to my market evaluation and make sure I talk through all those and give you a little bit of I really just want to tie these together into an outlook. And so if I start with points of concern, we talked about inflation just a minute ago. It's going to limit the Fed's ability to cut rates, which if we're stock investors, we want lower rates in the main, but we want them to be economically justified as well. Consumer confidence continues to be extremely negative. I don't spend a lot of time on that because at the end of the day, I'm really a stock investor, and consumer confidence doesn't necessarily have a lot to do with how if it's a good time to invest or not. You know, people tend to get nervous at the exact wrong times, tend to get over enthusiastic at the exact wrong times, and so it's something that I track, but it's not something that I spend a lot of time emphasizing. We've seen a dollar that was weakening earlier this year, but strengthening over the last month to 2 months. That just has to do. It's not necessarily good or bad. That just has to. Well, it's bad for domestic stocks, or it's bad for international stocks. That really just tells you where you want to be investing. And to see the dollar strengthening means you want to be in the U.S. Business loan delinquencies, I don't have on any of the slides. They have ticked up slightly over the last year, and then so that is one of the things that I'm monitoring. We have a couple of things as neutral indicators. I'm not going to sit here and repeat the whole slide because I talked about almost all of these already. This is just by way of recapping almost. The yield curve I have listed is neutral. It was negative within the last 12 months, which is still a concern, but it's been gradually strengthening over the last it's been almost 12 months since the last time it was negative. Unemployment figures have stabilized. I had those as a point of concern, moved those up to neutral. A lot of ancillary indicators. One example is manufacturers' value of shipments, and truck tonnage shipped, things along those lines that the Federal Reserve tracks inside of its database. Most of those show pretty strong economic strength, where it would kill the presentation to talk through things that granular, but they are things that we look at, and most of those are pretty positive right now too. Wages are growing faster than inflation. New jobless claims are on the decline in general. The manufacturing sector is growing. The services sector is growing. When I try to build all the stuff that I just went through into a picture, well, we're right back to where we were here. Mostly positive, not 100% positive, not universally positive, but data usually isn't when you're trying to analyze the economy or analyze the stock market. We're always looking for what way does the data lean, and it seems to lead towards the positive right now. I don't think stocks are overvalued. I don't think the economy is in an extremely precarious position, except inflation. Again, hitting low income people hardest, and causing specific areas of the economy to struggle a little bit. That's absolutely part of the picture. I'm not trying to paint it as 100% rosy, but when you digest everything, it sure seems to look positive. Just a couple of final thoughts because I'm going towards 1 hour. What I wrote on June 1st, I'm still referencing because it's still true, but it goes back to what we were saying before. April and May, we saw this boom in the stock market, and that was true because of the cessation of hostilities with Iran. It was true because we had already started in a valley by going down several percent, but it was mostly related to the unbelievably strong data that we saw in terms of stock announcements for earnings season. And so I wrote on June 1st, look, don't be surprised if we kind of trade sideways, have increased volatility, see some money cycle out of these high growth stocks. Until we get to the next earnings season, things tend to be, we go through this window where things tend to be correlated more on political announcements, more on Federal Reserve announcements, because there is no new data in terms of what an XYZ stock make. The reports still trickle in, but there's basically about 6 weeks where there aren't a whole lot of earnings announcements. That turns around, I believe off the top of my head, on July 14th. And at that point, all of a sudden, we're in earnings season again. I'm expecting the numbers to be pretty strong. Sometimes that gets to be a little dangerous because everybody's expecting the numbers to be pretty strong. And just like we talked about earlier, that eventually you get to the point where the good news can't keep up with the expectations, and that's where you start to see a little bit of a turnaround in the stock market, but then sometimes in the economy as well. My expectations are pretty strong for the rest of 2026. I don't have to predict that stocks will go up a lot outside of what their intrinsic earnings imply. If we just see movements along those lines, you're going to see decent stock returns for the rest of the year. Hopefully, all these things stay green. And we'll continue to update it on a quarterly basis. Remember, you can follow us on Facebook, Lifetime Retirement Partners. Please follow the YouTube channel. I assume that's what you're watching right now. You can go get all this information at lifetimeretirementpartners.com. And of course, and there is a mailing list you can sign up for. So click the blog, click the Q2 2026 report. And at the bottom, you can sign up for a mailing list to get this in your inbox every month. Obviously, feel free to reach out to us with questions. Again, I'm Tony Suick. I'm a financial advisor, a partner at Lifetime Retirement Partners. I hope this has been an informative and hopefully vaguely entertaining way to look at the market.